I'm Malachi Greb, CEO of Elite Automation, and I want to warn you guys of something that's very, very important when it comes to business, and that is funding. Be extremely careful accepting funding because it's something that can be devastating to your business. It could be something that ends your business before it even starts. And some people want to start a business and immediately go for some type of lending or external funding, and they want to have some startup type of company. Now, the issue with that is the debt always has to be paid back, right? There's always going to be an obligation to that debt. Versus if you just start a company and you're bootstrapping the company, there's not really any obligation. The only obligation is your own personal expenses. And if you're in the type of scenario where you have other support systems, maybe that's not even a problem. If you're already married and you have a wife, then maybe your wife can support you, or vice versa. If you have a husband, maybe he can support you, or friends or family. You know, you can sleep on a friend's couch while you're bootstrapping and starting up your business from nothing. However, if you take on funding, then you're gonna have that obligation that you have to pay back, and it could potentially be thousands of dollars a month or tens of thousands of dollars a month. And the next thing I really wanted to warn you about, and this is the main reason why I made this video, is because I want you to be very, very cautious of what we call suicide loans. So as we've grown as a company, we've taken on different financial debts. And we're doing that because we have an aggressive growth plan. However, there's debts out there that you do not want. And to be honest, there's been times where we struggled to get lending through your traditional like Chase banks and other big name banks that offer loans that have interest rates that are not too terrible, right? You know, we've dealt with loans where literally the loan is like 40% interest, and you just do not want to get into that, right? It can be completely detrimental to your business. One, you're paying back such a ridiculous amount in debt. You know, like some of these loans may be like, you know, we'll let you borrow $23,000 and you got to pay back $30,000. And then the next major issue is the time frame in which they want you to pay this debt back, right? It isn't like, okay, we're going to let you borrow $23,000 and then just pay back $30,000 next year. No, next week they want you to start paying the first payment that might be like $1,200, and then what you pay $1,200 a week every single week until that loan pays off, which is generally like 5 months to 12 months or something like that. Sometimes they go out to like 18 months, but regardless, you have all this obligation for debt for such a long period of time, for multiple months, right? And you probably took that capital and used it within, you know, a few weeks, a few days, or maybe a few months, right? But honestly, when you look at the amount of capital you get versus the amount of capital they take back from you, that $23,000, one, when they let you borrow $23,000, they immediately take off the top an amount, right? And the amount they'll take off will probably be that first like $1,200 payment or something. It's different for every single loan and everything like that. This is not like pure financial advice, but these are some examples that are very, very similar without exaggeration to how bad these loans are. So you might have that loan that was $23,000 they're gonna let you borrow, but they actually only deposit $21,000 into your bank account because they take the first payment before they even give you the money, right? And then so now you went from borrowing 23, paying back 30, but you really didn't even borrow 23, you really borrowed 21 to pay back 30. So there you're sitting at like 33% interest already. You're paying back against the money you've just borrowed every single week. So within that first month, you've already paid back $5,000 of this $21,000 that you borrowed, right? So you can just see how like ridiculous this is. Within like 4 months, you've paid back every single dollar that they let you borrow, and then you still have probably 1 year of making payments, or 5-6 months of making payments. So just stay away from these things that are called suicide loans. You can always tell these type of loans if they're a weekly payback or a daily payback. Any type of daily payback, any type of weekly payback loan, just completely stay away from them, right? Do anything and everything that you can. And also just search around on the market, right? Don't just go to the first thing that comes to you. And I want to give you guys a lending option that we found to be really good, and you might get approved for it. It's Fundation. Fundation is it's a line of credit, and a line of credit is really one of the #1 types of loans that you want to go for, especially whenever you're trying to like manage cash flow. So a line of credit gives you the ability to pull money and then give money back, and then pay that money back either over months times where you have monthly payments, or you can just pay it back anytime that you want. And then that money's then again available to you to repull again. So they'll give you a credit limit. Let's say they gave you the $100,000, and then that $100,000 you can borrow $25,000, pay back $25,000, and then you have that 100,000 still available, right? So that's another thing that's extremely nice about a line of credit. Like whenever you pay it back, money back to be able to use again. Now just be careful with lines of credit because they can also be dangerous as well, especially if you're leaning on that line of credit, because line of credits can get closed, they can get locked, meaning you can't borrow any more against them. And sometimes those things occur and it has nothing to do with your business at all. They could occur because of maybe the market itself. Maybe there's a lot of fear in the market that there's gonna be a crash, and then so all these lenders start pulling back their money, right? Anytime there's like, you know, major fluctuation in the economy, especially where things look like they're gonna be going in a downward trend, everywhere starts to either pull back their money or they start to raise up their interest rates. So just be careful of those things. They could definitely end you in a very bad scenario. But sometimes I know like lending is something that you have to do to kind of get to the next level or to cash flow, just bigger things as you grow as a company. You know, for us, like we've over doubled our revenue every single year, and it's challenging, right? Because you don't have, let's say, a ton of profit from the last year that can immediately go into covering the expenses of the new projects you have the next year, because they're just literally that much bigger. They're growing so rapidly that even the profits from the last year's, you know, revenue is still just not enough to cover like these next, you know, projects coming in. We're a project-based business, so you know that's the nature of what we do. So you know, the one thing that helps us in that regard is getting better terms with our customers. But to wrap it up with one last tip, definitely start by getting a bank account with a bank that has other options, right? One thing that I made the mistake of doing whenever I started the company is I banked with a bank that did not have options, or the options that they had were not options that applied to my type of business, right? Now, every bank has like the type of business they want to lend to, right? There's banks that want to lend to a project-based business. There's banks that want to lend to real estate-based businesses and commercial loans for buildings, or they want to invest in residential loans for buildings, right? And sometimes they fluctuate and change over time. Like I have one banker friend, and you know, he says, hey, right now we're not doing anything really in the residential space. You can apply, but we're probably not going to approve anything. But that's not the case. Like sometimes a few years later that'll change. They're kind of looking at their portfolio of what they're invested in, and then making a decision on what type of loans they should give out, so that way it diversifies and it has the balance that they want for their company. And these are all thoughts that you have to keep in mind, and like you really don't learn these things until you have experience in those things, unless you just happen to already have been a banker. But if you're coming from like some completely different sector, or you worked a 9-to-5 job and then you just started your company, then this is going to be like something you don't learn until you experience it, or you watch a video or something like this, because there's not a lot of content on these specific topics and really getting down into like some of the things that you experience as a business owner. So build that bank account with a bank that has the ability for other loan types, and they have a tolerance for your type of industry. So whenever you go into a bank, you need to interview that bank. Hey, you don't even necessarily need to tell them, hey, I'm thinking about opening an account here. You can or you cannot, doesn't really matter. But you need to sit down and say, hey, you know, what type of businesses do you guys like to invest in? There's some of them, let's say for instance, you have a construction-based company, and if you go in there, they'll say, we don't like project-based companies. We don't really invest in project-based companies, right? The reason why that part is important is because they may come to you and say, oh, look, we have lines of credit, we have term loans, we have all these different products, right? We have all the products under the sun. But then when you find out 2 years later that, oh yeah, but we don't allow any company that's a project-based company, we don't lend to any of those type of companies. Time is a huge thing when it comes to like credit and financial things, right? They're a history. They want to see a long history. Same with like your personal credit. It's very much like that. One of the things that we did to pivot and give ourselves a better financial strength when it came to being able to get lending and be able to have more financial options as we grow as a company is moving over to a bigger bank, moving over to Chase, where they're able to offer more products like lines of credits and offer them in, you know, like $500,000 limits, which is a lot better than a lot of companies. So it's still not extremely high for like the level of business that we operate at, but at least it's better than a majority of the banks on the market, and it's a heck of an upgrade from the bank that we used to have that really had no offering for a business like ours. So going back to the history part of things, you want to choose that proper bank and set your money, cash flow your money out of that bank account, right? You want to have all your customer payments going into that bank account. You want to have all your expenses coming out of that bank account, because there is business credit. But one thing is, when people talk about business relationships, means that the bank itself can see exactly what you've been doing. Like really, in today's age, like I don't think there's really business banking relationships as much as it is you're giving them the ability to see into your financials directly. You know how everything's linked together and everything's flowing into your bank account and out of your bank account. That bank can see that. And especially if your numbers and everything are good, then the bank can very clearly see, oh, you know, this business is doing well financially. They have good revenue coming in, and they can also learn your business over time to be able to help you out. This is where like the relationship side comes in, because you know, some banks, or a bank that doesn't have a relationship with you, whenever you show them, you can show them revenue, and then you can show them invoices, and maybe like invoice count is not high enough, right? Maybe your revenue numbers are really high, but like maybe you don't invoice very frequently. And so in instances like that, there's a lot of lenders that won't want to lend to you for those reasons. However, after you've built that relationship, now they can see into your bank account, they can see the money coming in, they can see how it goes out, or vice versa. You might be the type of company that has a lot of small payments coming in all the time. Maybe you have some type of e-commerce business and there's a ton of small money just frequently trickling in. And so they can see those things and see that maybe on the outgoing side, maybe you have huge chunks of money going out, right? Even if you have e-commerce and small trickles coming in, but then they see a big chunk going out, they can learn that over time and kind of see how your cash flow is as a company and make a determination on, okay, you know, this company's cash flow is really rocky, but you know, the revenue keeps climbing. They appear to be more profitable over time, and they can make that analyzation with their underwriters and whatnot to make that decision and be able to offer you more funding options. So hopefully this was useful to you guys. If you'd like any more content like this, make sure you hit the subscribe button, and we'll catch you on the next one.